Thank you all for coming back to our CFA lunches in person. It's great to see everybody live and in the flesh. Today we've got a new format for our lunches. We've got a panel discussion, and as you can tell, we'll keep it relatively informal and try to keep it an open discussion amongst all of us. And I'll let Ashby Price, our Director of Programming, introduce our panelists this morning.
What's up? Thank you, Thomas. Yeah, it's been almost 2 years since we've been in person, so welcome back. It's good to see you all in the flesh, as Thomas said. Want to thank our three panelists. I don't think we've done a panel discussion in the past 5 or 6 years that I can recall. So, yeah, I want to thank our three panelists, our three industry experts. So, I want to introduce Jonathan Braband. He is with Transact Capital Partners. Trey Packard. He is with Harris Williams, and Bradford Young. He is with Mercer Alternative. So, if you could just quickly give us an overview of your background and
all right. I'll start. I'm Jonathan Braband. I went to University of Richmond here in town and have spent the last 20 plus years in investment banking. Had the pleasure of starting my career with Harris Williams and have worked at large and small firms since. Transact Capital is a small boutique 20-person M&A firm out in Innsbruck focusing on lower middle market M&A transactions. And published a book last year on the topic of mergers and acquisitions, targeting business owners and helping them think about what they need to do to exit their company.
Trey Packard, I'm a director at Harris Williams. Have spent most of my career in M&A, broadly defined. Immediately out of undergrad was a paralegal at Skadden Arps in their M&A group, and decided to take the MBA path versus the JD path. And have spent a few years in Charlotte at Wells Fargo in their M&A group, and then in my 10th year at Harris Williams, spent the first half of that in our industrials group, and then helped start a dedicated group to private equity sponsor coverage, which represents about 80% of our total client base.
I'm Brad Young, co-CIO of private markets for Mercer Alternatives. I've been on. We work with large institutional investors developing and building private equity portfolios, usually through funds and co-investments. I've been in this side of the business since the mid-'90s when I started at the University of Richmond, prior to even Spider or private advisors being started. I spent 5 years at MIT, and then moved back to Richmond in 2004 to run a company called Altius Associates, which was acquired by Pavilion, then Mercer, so here I am. We advise at about 160 billion in private markets globally, and manage about 23 billion for folks across the private real estate, private infrastructure, private debt, and private equity.
well, thank you. And I want to keep this an open format as well, so I'm going to ask the panelists a few questions and then want to open it up to the audience. So the past 2 years have definitely been very interesting given COVID. What trends have you seen over the past 2 years in the M&A and private equity market, and what do you expect going forward, in a post-pandemic world?
I can start off with that one. I mean, I think simplistically, and we work at kind of the lower end of the middle market, sort of under the transactions that Trey and Harris Williams do. But simplistically, for my business owner prospects, we talk about pre and post pandemic in the following way. You know, it was a seller's market before the pandemic. There were more buyers of businesses than there were sellers of businesses of the types that they were looking for. And so that dynamic led to a seller's market. There was a brief interlude at the very beginning of the pandemic when M&A slowed dramatically, but it quickly rebounded as business owners got their footing. And I would say if you look post-pandemic, that equation has changed in that most of the buyers have returned to looking for acquiring businesses, but a good chunk of those would-be sellers, their window is closed, and they are unable to sell their business due to the issues that they had during the pandemic. And so that only exacerbated the seller's market that existed before. So we've got 90% of the buyers chasing 60% of the sellers post-pandemic, and until that supply-demand imbalance starts to reach more of an equilibrium, it's going to continue to be an even hotter seller's market than it was before.
Yeah, I agree. Maybe a similar themes, but maybe a slightly different perspective is, it's been a seller's market for A-plus assets that, really were able to weather COVID without major issues. We have certainly seen as private equity investors are being more selective than ever. If we're representing businesses on the sell side, usually you have a good idea of who the right buyers are, and you are trying to really create a bespoke message to them of here's where we think you have a right angle to prevail. A traditional process maybe 10 years ago would be reaching out to 100, 200 buyers. They'd learn about the business through, a one-pager or a CIM. Those days are largely over. If you reach out to a business and they're hearing about it for the first time through that initial outreach, it's going to be a quick pass. They are more focused than ever on areas where they have sector expertise or business model expertise, and when they don't have that angle, they are usually passing immediately because everyone is bandwidth constrained, and you're required to be more selective than ever.
I think I'm in a different part of the market, obviously. I'd say I was surprised how quickly everything transitioned online. The ability for GPs to come out and raise capital. They were able to raise capital, absolutely no problem whatsoever. The due diligence, our due diligence, we were able to complete it online, especially if we knew the groups. So it really hasn't changed. It just moved online really quickly. Now, some of it might not go back to in person. I would imagine some levels of how we work with people will go stay virtual, but we're going to go back to normal at some point in time. To echo some of the comments, though, our GPs continue to, they're paying, the valuations are still up. They're paying up for companies. And they haven't been, but quite frankly, they haven't been, down in the low, let's say, low single digits since 2002, 3, 4, something like that. People are paying for quality. Our GPs, we've been more centered in the growth area, so we've actually benefited a lot. And quite frankly, our clients, if they had exposure to venture or any kind of any part of the private equity market, with the exception of energy, generally the performance has been spectacular for the last 2 years, and that's realized, not just unrealized. Unrealized has been quite good as well. So I would say overall, if you were a private equity investor going into COVID, you probably benefited from a return perspective.
Yeah. Okay, great.
Well, to piggyback on your comment around online data rooms, online access to data. Overall, we find that buyers are primarily differentiating themselves with value, certainly, but also with speed. So if they do have an angle, they're moving very quickly. And it's fascinating. As advisors, we just have to be fully prepared to support that when someone raises their hand and says, hey, at an IOI stage, which typically would be kind of the middle of a deal process, they're, ready to sign and close.
I'm hearing the GPs are saying, okay, we're going to look at it. If we can't do anything with it, it's such a quick no.
Yeah.
We just don't have the levers to pull here to drive any value. And I hear that a lot, and it's more, you see, as we were talking right before lunch, it was more your increased specialization in certain areas. And I think if you were in a generalist buyout fund, mid-market, nondescript buyout fund going in, you're probably going to have more trouble unless you had some areas of specialty, whether it be financial services or software, you pick one. But a traditional generalist buyout fund is probably going to have trouble, I would imagine.
Well, if you don't have that sector depth, part of your homework responsibility, your diligence, is getting smart on the sector.
Yeah.
And so the groups that already have deep expertise already have a leg up.
Skip that.
So currently, the cost of debt is extremely low compared to historical standards. Has that impacted any deal activity and the way that deals are financed?
Happy to jump in. Yeah, I think we have certainly seen an abundance of debt. We think that lenders are, have been very aggressive. They're, covenant light still tends to be the norm. It's aggressive leverage limit levels, it's aggressive pricing, and it's aggressive terms. And all of that is, in the LBO environment, supports an abundance of deal flow of activity.
I think, I guess my impression was, covenant light was still the norm actually going into the pandemic. So, a lot of companies were able to survive quite well because of that. I think overall, I'd have to check, because we take a look at that, but I haven't seen an extreme swing in terms of use of leverage on average across the portfolio. It's not like, it went from 40 to 60 or something like that. I think it's still within kind of industry norms, but I could be wrong about that.
And the other thing that maybe, noteworthy is in the COVID downturn immediately, when a lot of private equity firms were, instead of pursuing new deals, were internally focused on managing their own portfolio, putting fires out, hoping that those businesses were healthy. I think lenders were frankly very accommodating. They're not in the business of owning companies. They didn't want it. It's one thing if you take the keys on one or two, but if you suddenly have 10 companies that you need to run, that becomes overwhelming. And so between that approach from lenders and I think a lot of capital just in the overall market, we saw fewer situations where lenders ended up owning businesses or special situations where people came in with more of a structured equity solution. I think a lot of people were raising their hand saying we're willing to invest to support businesses in that bridge, but there were probably fewer situations that actually materialized.
Yeah, it's interesting when it all first started happening. Everybody was making it analogous to the global financial crisis. But to your point, it's interesting. The GPs did not freak out. The lenders didn't freak out, and the LPs didn't freak out. So unlike the global financial crisis, everybody just kind of froze and said, "What are we going to do?" I was actually, during that, I was able to buy positions in groups that we wanted to get access to because people were scared to make investments. This time, I was actually getting calls from clients going, "Okay, where are the opportunities? What can we do? How can I invest more now?" And it's quite a turn of events from that. The analogies fell short pretty quickly because everything, like I said, back in 2009 was just frozen. Here it actually just seemed to go pretty well, shockingly. I think everybody was quite surprised. And, we analyzed our portfolios, and unless you were in leisure travel, hospitality, generally, if you were in good shape going in, generally you performed pretty well overall, if you took a look at the portfolios, back to my reference to how returns were.
Only thing I'll add to that, and consistent with everything they said, I was with some deal professionals earlier this week with GF Data, which produces a report on private equity statistics from the lower middle market up to, I think, $250 million in value. And one of the things they track is leverage over time. And while the multiples have gone up and the cost has gone down, the relative equity debt split has remained relatively constant, surprisingly. So equity is still just under 50% of most capitalizations of private equity-backed transactions. Just the whole, that's 50% of a larger number as the multiple's gone up, supported by a higher debt multiple.
Okay, great. Well, you mentioned that it's a seller's market, so with a potential increase in the tax rate in the coming years, has that accelerated any deal flow that you've seen?
We've certainly seen that. It's been a reason for business owners to reach out to us and start that conversation. I don't think it's been to your question. I don't think it's caused people who weren't planning to sell for years to suddenly say we need to exit. But I think for people who were already on that path and thinking that was coming, the exit was coming, is probably a reason to start thinking about it sooner rather than later. You certainly don't want to be caught, being an exit, selling your business just after a tax increase. So I think ever since those conversations started around the capital gains increase, we've seen more and more sellers start saying, I was thinking about the next couple of years. The pandemic was certainly one thing that's factored in my timing. This is yet another thing. Maybe we should go ahead and get started.
Okay, great.
For us, I think, I'll take it a little bit differently. Private equity groups as sellers and private equity groups as buyers. As buyers, I think to Jonathan's point, we certainly heard end of last year, kind of Q4 of last year and Q1 of this year, because of proposed tax changes. I think a lot of founder family-owned businesses, especially after a roller coaster of COVID and managing through that, were pursuing an exit, particularly, especially some companies that had never even thought about that ever before. As buyers, as sellers of businesses in their portfolio, I think that, the tax concerns, tax is always, I heard one person articulate, tax is always a concern, but not the concern. Like the primary focus is the business that I own and the management team well positioned for an exit right now. And then second, are the M&A market conditions going to support, the outcome that we want? So the tax is part of it, but I think those other two are much bigger factors. I think private equity firms, frankly, from a sale perspective, are more focused on kind of hitting that 3-year mark and getting over that, because those tax implications are more real than,
That's
say,
true.
those other.
Yeah, that's true. The 3-year reference is they need to hold something for 3 years so the carry can get treated as capital gains.
Yeah.
So oftentimes as an LP, I'll get something that says, we'd like to defer our carry because it's an early exit to later because of tax considerations. And that may move to year 5, and we'll see what happens with that. Yeah.
Ashby,
Yes.
one of the things I'm hearing is that family and founder-owned businesses maybe came to the market this year because of potential tax changes. But once they start looking at the prospect of selling it, and maybe it's the valuations and the values that they're seeing, they're deciding, hey, even if I don't sell this year, I'll go ahead and continue to pursue this next year, even in a higher tax environment. Are you seeing that at all?
Yeah, for sure. And we're seeing part of it, which all this that we've been talking has led up to a pretty big rush for transactions still trying to get closed in 2020, and that window is fast closing, with the exception of some of the buyers that Trey referenced that are closing very quickly because they were prepared and eager to, well prepared to jump on transactions in their sector. But for more generalist buyers who need to do, quality of earnings and need to do all the legal work, between the third-party advisors and their own internal capacity, it's unlikely, if you're not signed up now, that you're going to get closed by the year end. And for some sellers, that's okay. I mean, at the most simplistic, for a business owner, deferring their gains into calendar 22 allows them at least an extra 12 months to pay taxes on that, rather than have it to fall into the end of 2021, absent a change in the rate. So we've definitely seen people where that began the process, but even if it didn't close this year, they're continuing on with it.
We've also seen a lot of founder, family-owned businesses. Those owners have gotten a lot smarter, whether they, transacted or just started having the conversation.
Mm-hmm.
So a lot of large investors may buy a business, talking about the valuation spike, say it was something would have traded for 10 times a few years ago, is now trading for 15 times. But within an investment committee, you can sell that because it's a buy and build model, fragmented industry. We can buy some of these mom and pop businesses. If all those mom and pop businesses have had conversations with smart advisors, they're aware that, wow, maybe my business is now worth 9 or 10 times, not 6 times, which was what a lot of ICs had maybe underwritten.
Yeah. So Trey's referencing the idea that you overpay for or pay up for the platform, and then you can leverage down your multiple by making acquisitions at a lower multiple. And to his point, we operate more in that add-on acquisition world, and us and our cohorts around the country, I think, are doing a better job of trying to get more market-based multiples for those. And so that arbitrage between the platform investment level and the add-on is lower.
I'm a step away from that, but I know the GPs that we back that do the buy and build, one we talked about based up in Boston. I mean, they seem to have plenty of add-on activity, so somebody's selling.
Oh, yeah.
Yeah. So, and I do think a lot of these folks that are maybe owners that are selling, the values have already well exceeded what they anticipated anyway. So to sell and retire might be a good thing. So I haven't seen it. I haven't at least heard about GP saying they can't find deal flow because people don't want to sell or defer.
Just got to pay up for it, like
Yeah.
everything else.
Pay for it. Yeah, exactly.
So, Brett, I'd be curious on your take. What are you hearing from some of your institutional investors on kind of the sequoia trend and the evergreen structure and sort of permanent?
Certainly familiar with the Sequoia transaction. And coming out of the endowment world, certainly that was something we actually saw quite a bit. Like Sutter Hill, and there were a few other famous ones. This is causing, and just, I think everybody's seen it in the press, but basically Sequoia, obviously one of the most famous venture capitalists, capital firms in the world, is basically creating a structure where everybody who's an existing investor throws in their money and it kind of self-funds, and you just, you can be a participant in Sequoia, broadly speaking, and it's a way of accessing all the different funds. There's a few other firms out there that do similar things. I would imagine the Sequoia will be the exception because they can be, quite frankly. I don't think any other, there are a few other firms that can probably get away with it the way, but their returns, you know, if you've been a long-term investor in Sequoia, you've certainly benefited quite a bit. But the average firm is probably not going to be able to get away with it, or probably the GP or the LPs won't have the, because it's outside the norm, an LP might go, I don't know if I can do that. It's not the, 10-year plus the extension, the 2 and 20, it's a different structure. It's good for endowments or anybody that can hold assets for a long period of time, family office or something like that. But the traditional institutional investors might have more of a challenge. But that said, I would imagine Sequoia won't be oversubscribed at the end of the day. Yeah.
Yeah, Matthew.
Shifting gears a little bit, so CFA Institute has this, one of their white papers was on kind of like the finance professional in the future, and it was basically like, you guys have no people skills and you're more into computers, and so it's like, stop talking about spreadsheets and start trying to lead people and whatnot. So I guess I'm curious, whenever I think of M&A people, especially, it's that, maybe it's a little bit trite, but you're getting someone to sell their family. I imagine they're like, hey, you're selling your family business. This has been the baby. Yeah, let me just kind of hear a little bit about, how you guys build relationships and how that's kind of changed. I mean, in a world of Zoom, you could argue it's even more spreadsheet driven because it's not as human, but I still think there's that, I got to walk someone through this in many ways they're getting more money than they've ever had, but they're really losing their identity, I guess. So tell me if I'm wrong, but please.
Yeah, I mean, in the lower middle market, we're dealing almost exclusively with founders who are selling their businesses.
Maybe it's a family founder question
Right.
versus a PE.
For the first time, right. And so it is, a huge deal for them and their family. It's something that they've probably wrestled with and struggled with to get to that point. I think starkly, for me and our business, there's not a lot of unique process differentiation between what we do and the 10 firms in Charlotte and the 20 firms in Florida. And if you go to all of our websites, they talk about the same types of thing. And so to your point, it really comes down to personalities and the connection with people. And you can see sector expertise and there's some things on the margin I think can maybe narrow that field of hundreds of M&A advisors down to some that maybe are particularly well suited for a given assignment. But even then, there's going to be a number of them that could probably do a fine job. And business owners, when they're turning over their baby to that one transaction that's going to be the culmination of what they've built, I think the smart ones are looking for a team that they feel comfortable with, that they can commiserate with. A lot of what we do through the process is hand-holding and listening to the ups and downs of the deal and of their business, and rebuilding trust where they feel like the buyer is being disingenuous about something when we can see that they aren't. And they just don't have the volume of experience to go through a transaction to see what we see as kind of normal ebbs and flows. They're magnified in their mind. And so, as you think about an investment banking professional, at the analyst stage when we were starting out right after undergrad, our day-to-day responsibilities were heavily analytical and spreadsheet driven, and that just changes over time. And so I'm doing much less of that now and much more of relationship building and hand-holding and helping our clients see the big picture of here's how we're taking you through this process.
Has that really changed, I guess, is part of my question too?
Well, I'll answer it in two ways because I think one is for our senior professionals and maybe from an institutional perspective why relationships are important, but then maybe to creep into another topic that may come up later today, which is just talent retention and mentoring and junior resources. 70% of our business is with repeat clients, and so private equity firms, while we may be selling one of their businesses, there are a lot of private equity groups on the other side of the table who are buyers, and we're negotiating with them. But we also may be pursuing something that they own. And so, treating someone fairly is critical to our business model. If somebody gets burned, they're not going to think of us when they decide to exit their business. And so, our professionals have to be able to have that skill set. We also, as a boutique bank, don't have, 10 different MDs representing different parts of the bank in our pitches. We have, our deal team that's in there, and we want those people, we want, clients to see exactly who they're dealing with. One of the things as it relates to building talent, we love bringing our analysts and associates to those pitches, to those management presentations. Talking about like the definition of, the description of one firm versus another, how they're all the same. It's the same as, investment banking analyst or an associate. It's like, oh, what do you do? Oh, I build the LBO. Well, you can build the LBO anywhere. But the access to some of the intangibles, right? Being in front of people, or, hey, you've built a pitch book, but what you haven't done is sat across from the audience and seen how do they dig, like how are they digging into the charts that you built? Where are they asking questions? How does that make you a better analyst to predict from an analytical standpoint, where are people going to dig into the materials that you're presenting or creating? And that is something that I do think we've lost a little bit in the last 18 months. And so it's not just building the connective tissue kind of the water cooler talk. It's, being able for a junior banker to sit in the office when someone's on speakerphone, having a negotiation call, which is harder to do on Zoom. If there are two people on the line, that's one thing. If it's 20 black boxes on the Zoom screen, it's just, it doesn't really accommodate that type of conversation. So I do think building those relationship skills, at a junior level is critical, because, if you start burning, some bridges from a relationship standpoint, you realize that it takes a lot of work to rebuild those.
One funny question. Are bankers Zoom cameras on or Zoom camera off? I think analysts, like equity research, more off.
Yep.
The senior people are probably on, and the junior people are probably off.
Yeah.
100%, and something we try to encourage, more people to keep it on and stay engaged, or even better, be in the office.
Yeah.
Do you do the same thing, retaining talent and mentoring from the seller to the buyer, assuming that they're going to continue working for a while?
I'm sorry, in what way?
In deciding who you're going to talk to about a buyer-seller relationship, how much do you focus on like core values and retaining talent and, things like that? Kind of piggybacking on that question.
Yeah, I think as we go through a process, there's a winnowing of the buyer community, and there's sort of varying criteria to do that. And so most of the processes that we run will start off with a quantitative culling. So generally, are people in the same general valuation range? But then quickly it shifts to face-to-face meetings, or sometimes now preliminary Zoom meetings, where you start to feel more of the personality of each group and the culture fit, what their plan is for the business, which can vary wildly as you're talking to different types of buyers. They may have very different visions for what they'd like to do with the business post-closing. There's then another round of more quantitative analysis where final bids are put in and they're kind of stratified by value. But again, we encourage our clients at the end of the day to for sure consider price, but to make sure that they're also considering other intangibles exactly like the ones you mentioned when they're ultimately picking their buyer. And if you do it the right way like that, you're not wasting time by using some of the quantifiable metrics to make sure you're focusing on the most aggressive buyers. But ultimately, though, you're not blindly just picking the highest bidder at the end of the day. And we've seen clients successfully pick the second and third highest bidder because of some of those intangibles that ultimately I think was the right decision and they felt was important for the next chapter that their employees would be experiencing post-closing, for the next chapter of their business post-closing, and realizing at the end of the day, particularly for that founder seller, that it's not all about maximizing that last dollar, but it's making sure that the next steward of the business they built is the right one.
Yeah, we have certainly seen more situations in the last 18 months where sellers have considered that second, third, fourth place purely from a valuation standpoint. In large part, I think Brad alluded to it earlier, these are excellent investments. It's going to deliver a great return. But also we want to do right by the management team that we've been working with to build this value. And so, oftentimes they're sitting down with the management team saying, okay, here's where the final bids came in. Who do you like? Who do you have the best rapport with? And, because you're going to be working extremely closely with them for the next several years. And from a fiduciary standpoint, I think you can also say, oftentimes there is more rollover now than ever before, both from management teams and from the selling GPs. And so, there's also something to be said for, man, we want our management team to go somewhere where they're going to be happy, where they feel like they're most likely to succeed, because everybody wins in that situation.
Yeah, I was going to say, when you're talking about pricing, if the buyer or if the seller wants to maximize price, that drives a different behavior than if they're rolling over equity or they're backing the management team who's going to get the potential for a chunk of equity in the new. And I hear that from GPs a lot. They're like, well, we weren't the lowest, but we weren't the highest, and here's the structure. And a lot of successful GPs do that. And to your question about, in person, a lot of very successful GPs, especially in the lower mid-market, tend to be shall we say, I'm going to say, use the aw shucks a lot better than say, I'm from Wall Street and I'm here to take your business. And they give them a deal that they can brag about at the country club, say that it looks good for them, and everybody wins. So there's some very successful GPs that can exercise that and do a good job of it.
Yeah, so the lesson to learn if you're on the buy side of that is if you've got a seller where these dynamics play in, you don't have to be the top bidder. You've got to be close to the top bidder and be management's favorite or be the best culture fit with that group. And so selling all those intangibles during those management presentations, if you're on the buy side competing with other bidders for that business, I'd much rather try to do that and find management teams where I click with and where I feel like we're going to be management's favorite. As long as we're close enough on price, you hope that you get that call rather than only having to just continue to shell out dollars to win a deal.
Yeah, Brian.
I know you probably, Brad, seen a lot of activity in the venture space with digital assets, but I was wondering, in the private equity space, are you seeing buy and sell activity with companies that are mining or trading digital assets or doing other activities with digital assets?
I was going to say, anything with crypto or anything along those lines is probably, I'm going to be talking, I'm going to say, what's the best way to phrase this? Over your skis? Over my skis.
Stop the cameras.
In the venture space, certainly we see more of it. I'll have to admit, we haven't gotten our arms around it yet. The more sophisticated GPs seem to have a view on how it fits with blockchain, and there's a long-term trend there, but it still has yet to play out. I see bits and pieces of it. I did an interview with a GP called True Ventures, and they're still developing their strategy. They're talking about a crypto fund and maybe how it works, but it still seems to be a lot on the drawing board to how to actually kind of roll it out. I mean, it's getting a lot of press on CNBC and all of that, but I still have yet to see it really develop into a strong thematic investment outside of something broadly said called blockchain. Apparently, it's creeping into documents, as you might know, that you can fund companies now in crypto and digital assets. So we'll see where that trend continues. But
you see venture funds that can trade digital now like a hedge fund.
Oh, I know, and I avoid those. But so it's here to stay. The question is, where does it go? But I think, broadly speaking, people are looking at it as part of a broader blockchain view. But again, it's I don't know, Sean, have we heard anybody come in that's
it's just very, it's still a frontier at this point. It's interesting, we see a lot of LPs bringing it up, a lot of our institutional clients, or at least, they're having the same conversations that everybody else has. So, there's certainly interest in the space, but it's a very small piece of the overall market, and it's not something that I think, we're not bringing ideas necessarily to the table for clients, right? It's still too early.
Yeah. I will say when they first started to creep into LP documents about having transactions in crypto, a lot of investors got very nervous because I don't want my board thinking that we're funding terrorism. That came out. So a lot of transactions have to be approved by advisory boards of funds along those lines. So
the other thing is you don't want to liquidate, a lot of LPs, they don't want to receive stock and they won't cash.
Yeah.
And, you know, so the other threat would be that, yeah, do they start getting liquidated in digital assets that, you know, aren't as liquid?
Yeah.
That's the other risk.
Yeah, we're not recommending people take crypto as a distribution.
Well, ESG is a hot topic, and the CFA Institute recently rolled out an ESG certificate. So are you seeing more and more like deal flow and talks around deal flow incorporating ESG into investment strategies?
I'll start with that. Yeah, the ESG has been, on the LP side, especially in Europe, has been around for probably a couple decades, quite frankly now. It's been very ill, the letters have been thrown around. It's been a little bit of nobody knows what it is. It's, and everybody defines it their own way. But I'd say, I would agree that every firm, every GP has come up with an ESG policy of some sort, now varying degrees of where that stands. But if you went back 10 years, some of them are still saying, I don't know what that is. And we actually, every recommendation that we make has an ESG ranking on it. And the highest level is ones where it's actually the reporting that they come back and, they have a policy, but they actually have reporting on what's done. So it's really incorporated into what we do, and you see that across the LP universe. And GPs, it's just generally accepted that they know they have a policy. They're probably the lower mid-markets probably at the lower end of the learning curve, where the larger buyout funds certainly have ESG departments basically dedicated to them. But so it's here to stay. I think you're actually, and what I've heard is, and you all can comment on this, that a lot of companies are being positioned with better ESG metrics as part of the sale process. But I wouldn't speak for you all. But is that?
No, I agree completely. I think, whereas, I think, kind of you alluding to a decade earlier where people would say it was a little bit more squishy or the review process was very informal. Today, I think, most funds, above $500 million are saying they absolutely have scorecards with qualitative and quantitative metrics that they use dedicated to ESG. And if they don't feel like, they're up to speed on how to complete those scorecards, there are plenty of ESG advisors that are dedicated to doing exactly that. And so, I think the ESG angle is being used to create value. It is saying, how can we identify ESG opportunities to make this business better in our hold period and when we exit? How can we say that, that it's a value creation opportunity to buy something at 12 times, but over our ownership, better position it to be a 15 times exit? So, it's certainly, I think, the pressure is starting from LPs that are overseas, yes, European, especially Scandinavian, but certainly, more so, as private equity firms are needing to reach out and access more capital just because they're raising larger funds, they're accessing those pools of capital overseas. But even LPs in the United States are driving that more and more. I think somebody said, which I totally agree with, is that there's a tolerance for a long time in the U.S. of kind of being able to kick the can down the road, and there's an expiration on that's fast approaching.
I think it's going to be, I would say it's pretty accepted that you would have some type of ESG measurement. And if you're going to be an institutional GP, you're going to have some type of policy and some type of reporting mechanism around that. So. Yeah,
or it may not be the critical part of the investment thesis, but you better have a strategy in terms of what you're doing to improve that.
Yeah.
Sort of related to that, are you seeing a lot of activity on the energy side with people trying to sell energy partnerships on the secondary market, trying to sort of shed time?
Well, it's interesting. The question I usually get is, how many of your clients have divested because of not liking fossil fuels? The truth is, not many. At the end of the day, anybody who's had direct energy programs really just hasn't reinvested because, quite frankly, the returns have been so bad for over the last couple of years. And I would say that tide is changing. that actually energy investment, the folks that are inclined to do it, actually, they're looking at it now going, well, that's interesting. Now inflation's creeping into that conversation as well. So I would say I haven't seen too many sellers. Unless it's a specific partnership that's under distress for some specific reason. I haven't seen too many wholesale sellers, primarily because they knew they'd get killed on the sale. I see people now saying, okay, we're going to hold, and I'm now talking to people about adding and increasing their exposure. So now I don't think it's going to come back the way it probably was 10 years ago, but I think there's going to be an increase. I think also probably general acceptance that we're not all going to be on renewables by 2030 is probably going to drive that too. So.
Well, Brad, you mentioned inflation. And so are you seeing any inflationary pressures and like disruption in supply chain impacting deals and private equity as well?
Well, we're obviously removed from that. I would say it's a question that we talk to our GPs about with respect to their existing portfolio companies and say, do you have any, which companies are have supply chain problems? And also looking at new deals, how are you factoring in inflation into pricing? Does that change the type of deal that you're looking at? That's really how we're taking a look at it. You guys might have a different view on that or different.
Well, I think, in our business, where we see it is, more on the supply chain disruption is, going back to the theme earlier about people passing quickly if they feel like either they don't have an angle or, a lot of times you'll see an adjusted earnings base, adjusted EBITDA is here, but regular EBITDA is way down here. And so one of the things that, some people are anticipating in the next 12 months is if you now have pricing changes that are being implemented to make up for supply chain disruptions, well, those are all going to be presented on a pro forma basis. And if you've got a huge gap between the pro forma and the actual, it just creates an awkward conversation in an environment where people look at that, they see a big delta, a big bid-ask spread, and they say, I'm out, moving on to the next thing. So it'll be interesting. My guess is that if it's not easy to underwrite that pro forma adjustment, that those businesses are probably going to take a look about delaying when they actually sell, or at least being able to realize some of those pricing changes.
Yeah, I don't think a GP probably wants to take on those problems regardless of the price, unless they're some type of true value player. I would think
Absolutely.
Yeah.
Any more questions from the audience? Yeah.
Yeah, could you just, this is probably a pretty basic question, but could you talk a little bit about, for private equity participants, what goes into the decision process to insource or outsource your due diligence? And then secondarily, have there been any changes in the types of due diligence, or some due diligence becoming more important or less important given the macro environment right now?
Yeah, sure. Yeah, happy to. We were talking earlier about the ability to access data. It's almost like there's more data than you know what to do with, and so you have to identify where you really spend time. The diligence streams, I would say more diligence today is outsourced using subject matter experts than has been in the past, whether it's environmental or quality of earnings or market studies. So people do rely very heavily on those. We have seen in a market where you can have a competitive advantage on speed, however, we have seen people say, we might be in a situation where, for example, we know the market and we can work off of a draft study versus waiting for something to be 100% finalized. We may be more comfortable, moving that to kind of post-closing, or similarly on a Q of E, right? If the book kind of adjusted earnings basis here, and we're kind of on our draft Q of E aren't far off. We're not going to cut corners, but we're also not going to sweat the small stuff. There are certainly groups who have a track record of doing extensive due diligence, to the nth degree, and right now they're probably losing more deals because that slows them down. So I would say it's not benefiting people who are rogue, kind of taking a Wild West approach. It's benefiting the people that already have the expertise, or are saying, man, we're pretty comfortable with where we are on this, and comfortable enough to close some of these diligence streams post-closing.
Yeah, the only thing I would add to that is we've seen, to your point about what new topics, cyber has become more important and as a diligence stream. And so not just checking the box about what version software you're on and is it supported or whether was it homegrown, but what's your cybersecurity position and how well protected or not is the data that you handle.
We don't outsource any of it, including our operational due diligence. It's all done within Mercer. But we're actually diligencing general partners, not specific deals. In co-investments, we're relying heavily on the GP's due diligence themselves. So.
Is that the exception rather than the norm for Mercer? Like if you compare Mercer to the rest of the industry, do they tend to outsource that due diligence more?
Well, we have a lot of clients who work with us specifically on it. I would say for Mercer type entities, most of them probably do it themselves. They don't do it.
I will say for our business, for our employees, we are doing both. We are taking a fair amount in-house, but we're also working with some of these data analytics providers that can take these massive SKU databases and cut them in ways that, if you're trying to, prove out a pricing cube or something along those lines where there's upside from a variety of other things, it is just frankly too much for one or two of our analysts to manage, especially when you have organizations that are dedicated to doing it and can say, yeah, no problem, we'll put 20 people on this. So it's not that our analysts are offloading that. They're still doing a fair amount of it, but we're also getting, it's not just a spreadsheet that comes back. It's an output summarizing the data, and obviously it gets fully diligenced by buyers, but it can be overwhelming.
Well, and Trey's alluding to a trend that is referencing there on pricing and SKU data. It started perhaps with quality of earnings, but that is the sell side doing preemptive reports and analyses to present to the market rather than just waiting to be defensive to the buyer's due diligence teams. And so the more you can use third parties to validate and to help be part of the initial push of information out to the marketplace, you can close quicker and you just have a stronger footing to begin with. It costs money to do that, but if you've got an asset where it makes sense, getting some of that stuff done on your dime ahead of time can be really beneficial in the back end.
But those third parties also have bandwidth constraints like everyone else, so it's been fascinating to see that ripple effect just throughout the market.
That's right, all service providers do. It really is.
And I talked to one group that said that they pay for a market study team. We're paying all the time for 3 people. We may not be using them, but we want to pay, so if an opportunity comes up, we can have that team. And maybe they're not going to be dedicated to your sector. Maybe instead of having the Boston team, you've got the Mexico City team. But you got a team. Right. So,
Well, one last question I have. Y'all mentioned data. So when you're looking under the hood of various sectors and companies, what areas of the economy are you seeing thriving now, and which ones are you seeing in a recession or potentially going to be in a recession soon?
I'll start. I mean, there's certainly lots of pockets of activity. We are seeing a lot in technology-enabled business services. So we don't deal a lot with pure software companies, but companies that have been able to take technology and make a sort of real-world business service better and more efficient and more scalable. We are seeing activity there. Healthcare has certainly done very well. We've seen a lot in and around the home, and whether it's building materials or other services geared towards the homeowner. And then lastly, I would say, to the point of the infrastructure bill being passed, I think we'll start to see some of those old economy, more construction-related businesses start to do well as well.
Okay, great.
Yeah, I totally agree. I think some of the traditional industrial businesses have been slower to recover, at least from not in terms of their own business models, but in terms of M&A activity, those businesses being traded on a regular basis. But healthcare technology, and then consumer, particularly anything with direct-to-consumer e-commerce trends, or anything that to Jonathan's point about technology creeping into whether tech-enabled services or even in industrial technology, automation, smart cities. Technology is just obviously being is prevalent everywhere, but there are some businesses that historically have been kind of nascent and are starting to emerge. And then the last thing I would say is anything that's a kind of a regulatory driven service. So testing and inspection, thinking about aging infrastructure, things like that, testing bridges or power plants or large utilities, anything along those lines. Yeah.
We're seeing exposures to, we have exposures to all those, and I would agree. The, old asset-laden businesses are probably, GPs have definitely moved away from that. They don't want to get into a value trap or anything like, or take that on. Asset-light businesses, technology-enabled, it has been, done very well, and in fact, and same with healthcare, and we think there are a lot of tailwinds to healthcare going forward, especially so. But we don't bet in one sector. We try and have diversified portfolios. So.
Well, great. Well, thank you, Jonathan, Trey, and Brad. I really appreciate your time. And as a token of appreciation, the CFA Society of Virginia has a small gift for each of you.
All right.
Thanks very
Thank
much.
you.
Appreciate it.
Great, thank you.
Alrighty, we plan to have another in-person meeting at some point in December, so we will we'll follow up with an email to all of you once we have that date and the topic. So, Thomas, anything else you want to say?
We're good.
Okay. Well, thank you. Good to see you.
Thank you all.
Thanks,
Okay.
Al. Thank you.
I really appreciate your time. Yeah, thank you.
Nice to meet you.
Yeah, really enjoyed meeting you. Yeah, that was fun. That was enjoyable.